I've had many questions about this new feature on Trading 212 where it gives you a kind of balance score for your pies. In this video, I'll go over what rebalancing is, how it works, and why you probably don't need to do it as often as you might think. Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that we discuss is intended for information and educational purposes only and should not be considered investment advice or investment recommendation. Whenever you invest, your capital is at risk. I've covered the topic of rebalancing and what that big, mysterious rebalance button does in a previous video, and you can watch that here. Since that, Trading 212 have created something called a balance score, and they haven't really explained what it is or how it works. But it's the traffic light colours, and that gives the impression of a warning. Here are some examples of the balance scores from you guys. If you replied to the post on Trading 212 community, you can have a look and see if you can find yours. Now, as you can see, there are a range of levels of balance here, and the three colours to give an indication of how unbalanced your pie currently is. However, I think this is a little bit misleading, and I'll explain later, but first, what is rebalancing? Rebalancing involves realigning the weightings of a portfolio's assets by regularly buying and selling to maintain an intended asset allocation or risk level. For example, a conservative portfolio might have a 60-40 split between stocks and bonds. However, if stocks grow faster than bonds, the portfolio might shift to 75-25, becoming riskier than originally intended. To restore the original balance, one will need to sell some stocks and then buy bonds. This process inherently supports buying low and selling high, a good investor's mantra. But why rebalance your pie? Rebalancing is a strategic way to maintain a balanced, resilient portfolio over time. By selling high-performing stocks, you lock in profits which prevent any single stock from becoming too large a part of your portfolio, which reduces the risk of overexposure. At the same time, rebalancing allows you to reinvest in stocks that may be temporarily undervalued. This buy low, sell high approach strengthens your portfolio by positioning it to benefit from recoveries in undervalued assets while reducing dependence on stocks that may be peaking. In dividend-focused portfolios, rebalance can also boost your overall yield. When stock prices decrease, dividend yields tend to rise. By reallocating funds from high-priced stocks to those with higher yields, you can enhance the income potential from your dividends. Additionally, rebalancing ensures that your portfolio stays aligned with your target asset allocation, helping you manage risk according to your personal goals. This disciplined approach supports long-term stability and growth, allowing you to stay on course towards your financial objectives. Ultimately, rebalancing helps optimize returns, increase income, and control risk, especially valuable if you believe in the long-term potential of your investments. The argument I hear against rebalancing is that you should let your winners run, i.e. let the best performing stocks in your portfolio keep winning rather than selling them off to feed more into the relative losers. The problem with this logic is that the pie, in its nature, is a strategic allocation. This means that when you created the pie, you deliberately chose how much of each of the stocks it should be. Rebalancing simply brings it back to this allocation. Remember, you chose that allocation, hopefully for a logical reason. If you wanted a tactical allocation, it's better to do that outside the pie. Now, people have mentioned that they like pies to categorize their holdings or import their holdings into pies rather than buy with the target allocation in mind. If you're doing that, then you can or should completely ignore the balance score. It's not relevant for you. So how do you rebalance? Now, we're talking specifically about pies on Trading 212, so these instructions are going to be Trading 212 specific. And talking of Trading 212 is also the sponsor of this video. So if you were thinking about making a pie and perhaps rebalancing it, then you'll need to open a Trading 212 account. And I asked Trading 212 if they could give me a unique code that you guys can simply type into the promo code section, capital at risk. So if you've opened a new account recently, or are planning on opening an account, then here it is, DivXP or DIVEXP, short for the Dividend Experiment. So you have 10 days from opening your account to type this in and receive free fractional shares worth up to £100. I also get something as this is my custom code, so this helps you support the channel too. What does the pie rebalance option do? If the investments in your pie deviate from their target allocations, the balance within the pie will shift. To fix this, you rebalance the pie anytime by selecting the rebalance option, located at the bottom of the holdings section. The rebalancing algorithm will automatically make the necessary adjustments to equalize the actual value and the target value of each investment. Note that position losses may occur during the rebalancing. So it will sell shares of overweight investments and purchase more of the underweight investments. And prior to executing the rebalancing, you'll be provided with a preview of the changes. Rebalancing transactions in non-base currencies will be subject to a 0.15% FX fee and may take time if the markets are currently closed, or if you have investments in multiple markets and only some of those markets are currently open. You'll get notified immediately after the rebalancing is concluded fully. Now for the million-dollar question, how often should you rebalance? I'll premise this with the fact that every time you rebalance, you are losing a little piece of your portfolio through general attrition. If you buy a stock, sell it, and buy it again as quick as you can, then you'll likely have a slightly smaller portfolio than when you started, and that's due to the fact that buy price and sell price are not the same. There's a small gap between the buy price and sell price called the spread. Also, if you're buying and selling stocks in another currency to your base currency, then you're also paying the small FX fee on the platform, which is 0.15% at the time of making the video, on the buys and sells. So with that in mind, you should rebalance sparingly. Very frequent rebalancing is eating into your portfolio returns unnecessarily. The next consideration is how you deposit into the pie. Trading 212 gives you the option to make a deposit that aims to self-balance with the additional capital being added. So in other words, the extra money you add simply tops up the relative losers to try and balance it that way. So if you're depositing in that way, it's likely you'll not need to rebalance as often. Rebalancing also has nothing to do with whether your pie is up or down and won't help with either. Studies show that frequent rebalancing doesn't yield significantly higher returns, and portfolios rebalanced monthly, quarterly, semi-annually, and annually perform similarly, but portfolios that were never rebalanced significantly underperformed. And now that Trading 212 have released their own proprietary balance score, what score should you start to think about rebalancing? Trading 212 don't actually explain the mathematics behind how they calculate their score, and let's be honest, I probably wouldn't fully understand it if they did. However, I do still have an opinion on it from looking at how it works over the last few weeks. And it could be controversial, but I think that the colour system shifts way too soon. In nature, you have the frogs or snakes with the red or yellow warning colours. This kind of means stay away, I'm super poisonous. So it triggers some primal reaction of panic in our chimp brains. So when you see your pie flashing yellow or even red, you might look at it and think you need to do something ASAP. In my opinion, you don't need to even think about rebalancing until it's something like 6.5 on the balance score. From what I've seen, it turns yellow under 9, I think, which is pretty balanced for all intents and purposes, and then red under 6. Now don't get me wrong, under 5 is probably pretty unbalanced and deserves to be red, but 8.8 is pretty much the normal fluctuations of the market, and rebalancing at that point feels a bit extreme, yet it comes up as yellow. Anyway, you may disagree, and as Trading 212 themselves say, you yourself are responsible for all investment and rebalancing decisions. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!